Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, December 2, 2014. Let's go over to a daily chart. This is the SPY. And basically, we took back the loss from yesterday, and this was Turnaround Tuesday. So it's not out of the ordinary for us to have a down day and then an up day, specifically on Tuesday. It happens a lot. However, I still believe that we're in the midst of a, let's call it a week and a half, maybe almost 2-week correction. And even if the correction doesn't necessarily go all the way down, even if we move sideways to slightly lower most of the time, whether or not we get to my target or not, as long as we have a consolidation for a week or two, that will poise the market to move higher into the end of the year. So we'll have to see what happens, see how it plays out. Again, like always, we let the market tell us what to do. We don't impose our will on the market, but we'll see what happens. There was a lot of stocks that were not necessarily up today, even though it looked from the surface like a relatively strong tape. Like, for example, let's look at a couple. We had Apple that was not up today. Okay, whoops, my charts are not working. Okay, that's LinkedIn. LinkedIn was down. Apple was down just 44 cents today, but it wasn't up in what seemed to be a strong market. LinkedIn was down $1.79 today. Baidu, which is a strong Chinese internet stock, that was down 187. Microsoft was down 16 cents. A couple of energy stocks were down, and a lot of energy stocks were up today on what I would call a rebound rally. Transocean or Rig was up down 61 cents. Halliburton was down 87 cents. McDonald's was down 67 cents. So, these are the type of stocks that you would expect when the Dow's up 110 points. Or 102 points, and the S&P's up 13 points. You would expect a lot of those stocks to be up. Google was down today, dollar and change. So, it was kind of a mixed bag today, being that we had a lot of the market leaders, what are normally market leaders, that were down. And, obviously we had a lot of stocks up as well, but usually those are the names that we see up on up days. So a little bit suspect, but we'll see what the next several days bring and what happens from there. Let's move over to the oil market, and let's take a look at the USO. And the USO sold off a little bit today. It was down 74 cents. And, that's a little bit of a weak showing. Crude oil was down about 2% today. And it's up 1.5% or 1.5% after hours in the Globex session. But all in all, there's still a lot of weakness out there. There's still a lot of deflationary talk out there, which we're going to get to a little bit in a couple of minutes here. And so we're not out of the woods in oil. I don't know that we've made a bottom yet in oil. Maybe we have. We'll have to see what happens. But we really haven't seen the high volume reversal day that would constitute a bottom in oil. So we're waiting on that, and we'll see what happens. But oil was weak today, and just the same, gold, I don't know why my charts aren't working. Sorry about that, folks. Gold was not necessarily strong today. It was down $1.44 on the GLD, and spot gold was down about $20. But you know what? After an up day like we had yesterday, and remember from the overnight session from Sunday evening when gold opened at 6 p.m., it went all the way down to 1141, and then it finished at 1220 something, if I remember correctly, yesterday. So that is an enormous move in one day, and from there you would expect some kind of a pullback, and we might get a few more days of what would be consolidation. And if that happens, we would be looking for another move higher. At this point, I would say the odds on going down to test this low are diminishing as we speak. It's not out of the question. Nothing's ever out of the question in markets. However, the odds are diminishing because you kind of look at what the market is telling you, and the big up move yesterday tells you that there was a lot of accumulation in gold. That means that big players were buying big numbers in gold. And when that happens, okay, the likelihood that it's going to go back down, for example, to 1100 or 1130, where the bottom was down here, okay, begins to get less and less likely. So That's my take on that. Let's go over real quick to the interest rate market, which we haven't talked about in a while, but I want to make mention of the interest rates because there's a lot of discussion about the Fed raising rates in 2015, what's going to happen, and all that stuff. So I contend that we're still in a trading range in interest rates, which means we're in a trading range in the bond market. So on the upside, I think the top of the range for now would be about 250 in the 10-year. This is the 10-year. TNX is the 10-year Treasury bond interest rate, okay? And on the downside, I think, somewhere in this neighborhood, about 215, 220 would be the downside limitation until further notice. But for now, that's kind of the range we're in. So you figure here to here is a good range, and we'll probably bounce around there, and that'll hold bond prices relatively steady, which will hold the municipal bond market steady, the corporate bond market steady. We're going to carve out the junk in the high yield bond markets because I talked about that last night, and for example, the energy sector is susceptible and I think has been putting pressure in the high yield and junk bond markets. So that's not included when I have this rate discussion on the Treasury. Okay, those are separate markets, and they're much more volatile and they're much more risky markets. Okay. Further that, so let's talk about Japan and Europe, right? And this kind of ties into gold, but they're intent on creating inflation. They both have target rates of inflation of about 2%. Okay, and we're nowhere near 2% inflation in Japan, and we're nowhere near 2% inflation in Europe. In fact, inflation has been contracting specifically in Europe and Japan for that matter, and that's why they're fighting deflationary forces. And that's why, for example, in France and Germany and a couple other countries, your rates are so low right now to lend money to their government and get a return on it that you're actually paying them to hold your money. That is a tell of what's coming in the future. Again, the future doesn't have to be next week or next month, but the future is telling us, or the fact that you have to pay a government to hold your money is telling you that money is scared. And if you're willing to pay the government to hold your money, that seems like a recipe for a disaster in the making at some point in the future. We'll see what happens, but that's not anytime soon. It's just a tell that we see into the future. Okay. The other thing I want to mention when we circle back to the energy market is Venezuela has been absent from the news, but you have to look under the covers and you'll find that Venezuela, their main export is energy, is oil, okay? And when oil prices contract, okay, Venezuela is having issues. Russia is having issues, okay? Venezuela has bonds that could potentially go into default if oil prices remain depressed. Okay, so this oil phenomenon isn't only the small players here in the U.S. and the junk bond and high yield market. This is a global issue. In terms of Russia, Russia's export of oil and gas. If the oil price stays low and Russia has a difficult time, essentially producing revenue for itself, okay, that could put deflationary forces, not only which are already there, deflationary forces in Russia, but all across Europe. And that's what they're fighting, and that's why they're going to do everything possible to create inflation. And that's why I kind of brought all this up real quick, because it ties back to gold. And when they're going to basically get out the bazooka, like Hank Paulson did in 2008, and he wanted to have a bazooka which would basically paper over the financial sector so that there wasn't a run on the banks and a financial panic here in the U.S. and that could go global. Okay, it's the same thing that's happening in energy right now. And I know I talked about it last night, but I can't stress it enough. It's the same thing in a different industry. Okay, the lower oil prices go or remain, the more pressure that Venezuela has, Russia has, we have here in the U.S., other parts of Europe, Canada, okay, all across the world, you're going to see deflationary pressure if the global commodity prices contract and oil prices contract, and if all these central banks flood the market with money, which they are doing and they will continue to do, okay, people will fear that they must own gold, and that will push the price up. It's not the money printing that pushes the price up. It's the fear that people have of the money printing, and that's what pushes the price up of gold, okay? So that's kind of where we are. And don't forget, the Fed for years created QE1, QE2, QE3, QE9, whatever it was, okay? And then and they were intent on creating inflation, but all that money just went into the banks and it didn't get out into the larger economy. So they really were never successful in creating the type of inflation they intended to do, which is why gold from 2011 until now has been depressed and on a decline. But I believe that the decline is over, or at least near over, and Europe and Japan are going to be the catalyst for the force of gold moving higher. And I think it was worth a discussion tonight because it's very important. You're not necessarily hearing this on a regular basis, and I think it's important that you understand everything that's going on, okay? And for a while, those inflationary discussions and forces will also lift stock prices up, at least for the foreseeable future. And that's why I believe after this consolidation or correction that we're going to go through in the next week or two, okay, we're going to see higher prices into the end of the year and probably higher prices into January. And then I'm going to give a forecast for 2015, and you'll see that there's going to be quite a bit more volatility, I believe, in 2015 than there was in 2014, and all the reasons why, there's a fifth year of a decennial cycle, which is the 2015, which is normally bullish for the market. The third year of a presidential cycle is normally bullish. And then you have opposing forces that are going to pull the market in other directions. So you're going to have a push-pull in 2015, and it's going to provide a great trading environment. But if you're not on the right side of the market, you could get whipsawed, and there could be a lot of devastation in terms of lost money in 2015 if you're not on the right side of the market. So as it goes, we'll give you the forecast in 2015 in a week or two, and then we'll be back tomorrow night with our Wednesday night forecast. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.